Welcome to the Courtier Commodity Report, where James Cordier breaks down what's really driving gold, silver, oil, and the global economy. We'll go beyond the noise to explain the cycles, data, and signals beyond major commodity moves. Hola, I'm Joe Pardavila. Let's get started. James, how are you today?
Doing well, Joe. How about yourself?
I'm excellent. And I've been meaning to ask you this question for the weeks and months that we've been doing this podcast together. And so we all hear these stories about gold reaching record highs and everyone should have some gold in there. I My question is, how do I buy gold, James? Like, I know this. I'm starting with a random questioner because you hear people say buy gold, but do I go down to the bodega? Is there something online? Where does one buy gold in 2026?
Well, I've been interviewed several times on CNBC Arabia, which is based in Dubai. And if you live there, you can put money or your credit card into a vending machine. That's how prevalent it is there. Of course, in the United States, there is hundreds, if not thousands, of places to buy gold or silver from, whether it's a coin shop or a bullion dealer, what have you. You can definitely get your hands on some. It's just requires a lot more greenbacks than it did a couple years ago.
Okay, because I love the idea, and we talk about this all the time. But I'm like, I've seen we buy gold stores, but I don't see a lot. We sell gold stores.
Yes, that's true. They do want to buy low and sell high, and maybe they're offering it to their cousin who runs the other side of the ship because it is for sale. If you're willing to pay up the price right now, you can get your hands on lots of gold if you want to.
Awesome. Thank you for indulging me, James. Obviously, we cannot do a commodities podcast without talking about oil. It's what everyone is talking about. I mean, I think little old ladies down in Florida and old men in Texas and kids in New York know about the price of oil and how crazy it's gotten. Does the current oil price increase resemble the increase we saw in precious metals earlier this year?
You know, Joe, it's starting to feel like it. And that is so interesting. Of all the commodities that we follow, all the commodities that are traded in New York and abroad, the one that, or the two that everyone seems to have a good handle on is the price of gold and the price of a gallon of gas. People just hate the idea of paying, they're standing at the pump, they're pumping and pumping and pumping. And my God, it's like $60 when it used to be $50. It's 100. It used to be 80. And people are really familiar with the price of crude oil and the price of gasoline. Of course, the war started a little bit over a week ago, and zooming up go the prices for gasoline at the pump, and of course, crude oil barrels as well. But interestingly, Joe, to answer your question, it was like the perfect crescendo in precious metals a little bit earlier this year. We had the idea that we were going to have 3 or 4 rate cuts here in the United States, which would pressure the value of the US dollar, which of course is bullish for precious metals. We had the AI build out, the data centers, copper and silver are needed by the tons in order to do this. But what a lot of people learned is that that's more than just a push of a button and voila, these data centers are built and we've used all the silver. We've learned that that's going to be a much slower process than we thought earlier. That was going on. The idea that the dollar was going to lose value was going on. The AI buildup was going on. And then the third catalyst to what I think created the perfect storm in silver prices, especially a little over a month ago, were people cashing in their Bitcoins for gold and silver. From one of the first times that I can recall, we had Bitcoin going straight down and precious metals going straight up. And clearly, people were liquidating some of their Bitcoin holdings to get into precious metals. And that's what that certainly looked like. Furthermore, what's happened now in crude oil feels a lot the same. We have basically a crescendo going on right now. Everyone's talking about, well, China gets 50% of their crude oil through the Strait of Hormuz, and now it's closed. And then we have a new supreme leader in Iran. So we're back to maybe where we started from. Just really feels like a crescendo, if I don't mind saying. It really feels that way. We hit $120 a barrel today. And uniquely, the exact same price for an ounce of silver was $120. And won't it be interesting to look back on this a year from now and they both topped out at the exact same price? I think that might happen.
Wow. And so what does this historic rise tell you about, just in terms of where we are today? What is it just because of everything that's going on in Iran? And is there anything comparable that you can see like over the course of history and over the course of your career that it's just like this is what happens when there's a conflict in a hotbed for oil?
You know, Joe, it certainly seems that way. The biz stations, the news stations, they just love conflict because it sells. And these missiles taken off from these aircraft carriers, the bombing of jets and missiles in Iran, it just gets people going. And it just seems as though I should buy gold or I should buy oil when I see these things happen. But the fundamentals in both of these markets, both precious metals as well as crude oil, don't justify the prices that we reached recently. And we can certainly get in the weeds a little bit on that if you like. That's what it is that we do. And we love the weeds.
Yeah, and so let's get into that price thing that you mentioned. Since you've been trading metals and oil for decades, do these dramatic increases feel like that they've topped? Like, can it get higher than this? Or have you seen it higher than this?
You know, interestingly, when I started trading crude oil, we would buy it in January at $20 and we wait all year for it to get to 21.
Wow.
Move a dollar in a year, and now it's moving $5 a day. So this definitely feels like panic buying, a little bit of short covering, and of course, short covering is when prices are going up and open interest is going down. That's the number of contracts traded at the CME and in New York at the exchange there, as well as in Dubai and around the world. When open interest is falling and prices are going up, that means that weak hands are buying the market, getting out of bearish bets. And we've seen that now 6 days in a row. And the fundamentals just don't really justify $120 oil as far as we can tell. So much is being made about, well, China, 50% of their needs for oil comes through the Strait of Hormuz. It does. And now it's lacking, 2 to 3 million barrels a day coming through this area. China consumes approximately 16 million barrels of oil a day. So needless to say, they want to keep oil flowing, if you will, to that country. But think about this. There's something called floating storage, and these are tankers on the oceans around the world sitting with some 400 million barrels of oil, just waiting for someone to make the phone call. We'll take some. In addition to that, it's thought and estimated that China has oil reserves of 1.4 billion barrels. Okay, so China has been very good at buying low and using the product high. And now is probably when they're going to use those reserves because, simply spoken, um, if they purchased oil over the last 10 years at $30 a barrel and $50 a barrel and $60 a barrel, they're pretty smart commodity traders. I think they're going to use some of that cheap oil right now, burn off some of that 1.4 billion barrels that they have, and maybe stay out of the market. They can't stay out of the market completely, but they can slow down purchases right now as oil hits 120. If you look out in what we call futures contracts, next April, oil is sitting around $68. That tells us that a year from now, give or take, this entire rally in oil will evaporate, and prices will be back down to a much more palatable level for both the administration as well as people at the pump.
So you kind of alluded to there, but do these inventory levels support the recent move in oil? And the reason I bring it up, and I almost want to bring this up in sort of a tangential, sort of random way, is that here in North America, we talk about the fact that we pump so much oil, right? We are, I think you said the stat, we produce more oil than anywhere else on the planet. Yet the price moved so fast. Like it's almost like the first rocket hit and the price immediately fluctuated. And to me, I'm like, how does that even? I can't even process how a price can happen when when we know we have a lot of oil here, but we'll have trouble getting it down the line. Why would it change so fast? And depending on like these oil levels that we're at now. Can you explain that, James? Because that's the one thing that drove me crazy over the past week of seeing these numbers rise. I'm like, how do they know that the price should go up so high when we know we have so much oil sitting around in the ocean?
I think the hype, Joe, and the media is very good at doing that. They'll bring on one talking head after the next. This talking head says oil's going to 150. Well, he gets a lot of notoriety for saying that. Well, this large bank or this professional trader thinks it's going to 150. Well, they got to call around and see if someone will say 175. And then that talking head gets put on TV the very following day. It's going to 175. And a lot of people watch these shows, and then between the segments are the bombs dropping in Iran. So it's a lot of pandemonium. I think it's panic buying. The supply demand figures simply don't justify oil at 120. But we are talking about the Middle East, and we are talking about a lot of the barrels produced in the world come from there. So if you are sitting with a position that you want to take a flyer on, maybe buying oil at 110 or 120 might be a good idea. But longer term, the futures contracts 6 months and 12 months out say you would be doing just the opposite. So we'll see how that plays out.
Yeah, I mean, to me, I almost wish like, please stop saying how much oil we make here because it's obviously just BS. Because if you're telling me we're producing all this oil and then within the first hour of a conflict in the Middle East, we're going to jack up the prices, exponentially. To me, it's hard for me to wrap my brain around that. And again, I mean, I guess like you said, it all goes back to the fear. But to me, it's like, how can you even like let fear drive you so quickly? I could understand, James, if this conflict was lasting weeks and months and we see these prices spike to these all-time highs, but for it to happen so immediate is just really, to me, just it's obnoxious.
It is. It's like price gouging at its very finest. Whether it's traders that are boosting the price or the media that's helping to boost the price or just investors and speculators pushing it up, that's where I'm talking about the perfect storm. I mean, it's just ideal. I think we're going to look back at this 6 months from now and 9 months from now, look at charts for crude oil. It's like, what the hell happened there? It's like, oh yeah, that's right, the Iranian war. The fundamentals don't justify the prices staying up here. Granted, if something happens in the Middle East that is like completely, off the charts here, pardon the pun, could oil still stay above $100 and perhaps go slightly higher? It could. But Joe, I'm not a military expert, but what I'm hearing now is that a whole lot fewer missiles are being sent around coming out of Iran than there were just a week or two ago. So needless to say, I think they're running out, and all the salvos that are going over Iran right now are starting to take their toll. And perhaps in a week or 10 days, this thing might be winding down.
And so, not to predict futures or anything like that, because we don't like to do that here, but like if the conflict were to end, say today, right? How fast would we see a price drop, if any? Like because if you think about it, this would have been like maybe a 10-day conflict. How fast do you think you see a dip, or is it one of those things where like, oh no, wait, who knows if we're still going to be able to get the oil, even though this conflict is over? We still don't know. Like, how much of a swing do you see there?
Joe, I'm not sure if you're old enough to remember the trickle down theory, but I think it goes up extremely fast. And I do think that we're going to give back all of this gain over the next 30 to 60 days, but it probably won't go down as fast as it came up. It just, for whatever reason, it doesn't seem to do that. And I guess they want to protect themselves and make sure that, what appears to be the end of a conflict or war actually is the end. And that's why it probably won't come down as fast as it went up. But we do believe it's heading south here. During the month of April and May, I think we're going to see prices quite a bit lower than where they are right now.
Yeah, it is funny, James, right? How quick they're able to go up and how slow they are to come down. It's almost like if you ever had an issue where you've had to return something and they're like, oh, okay, but it's going to take 6 to 8 days for it to go back on your credit card. Well, wait a minute. You were able to take it out of my credit card instantaneously, but it takes a week to put it back? It's funny how the math works in those scenarios.
It is funny. I've heard of that, and I think that's how the price of energy is going to go down, just like that person waiting for the rebate on the credit card. I think it's going to work about the same way.
So other things that influence, how about like central bank policies? When a conflict like this is going on, does it really even matter what some of those central bank policies are, or is it just because the headline and the story is just basically conflict? But do the central banks have anything to do with with the price right now?
Central banks are integral to the price and value of precious metals. Not so much energy is not so much crude oil. The central banks, of course, were notorious buyers of gold all of last year, breaking all types of records. We don't have enough gold, and the value of the dollar is going to go down, and we just want more and more of it. Central banks were very instrumental in having gold reach $5,500 an ounce, perhaps silver getting to 120. For whatever reason, when the value of the dollar is in possible jeopardy, people freak out and they want to buy gold and silver. And granted, um, there's $37 trillion of U.S. debt. That's paper money that is backed by quite a promise, but 37 trillion. So you would think that some investors who are a little bit conservative would want to trade in some of their millions of dollars and get millions of dollars worth of gold. We heard a lot of that at the end of last year and the beginning of this year, and it's kind of tough to argue that idea.
And so is it very much yin and the yang when it comes to the US dollar? Like, so if the US dollar is low, that's good for the oil and metals markets. Explain that to me, because you kind of alluded to the fact about like what the value of dollar and its effect on oil and metals.
So energies, precious metals, all priced in U.S. dollars. So when Japan or China wants to import, 5 million barrels of oil on a particular day, they need to change their yuan in $4 to make that purchase. So when the value of the dollar is down, chances are they are getting more bang for their buck and they are able to purchase more of a particular item, gold, silver, or crude oil. And the reverse is true. So when the value of the dollar is quite high, they do the conversion and now they can't buy as much. And that's kind of the yin and the yang of the value of the dollar and some of the commodities that we follow.
Cool. Let's get into trader psychology a little bit here, because what we've been talking about the last 10, 15 minutes about the fluctuation of price depending on the conflict. When markets move this quickly, and we talked about how the price of oil went up pretty fast before anyone even knew what was actually happening to the oil, what mistakes show up most often among traders when you're seeing this volatility?
It's a reaction to what they're hearing, what they're seeing, and talking to other experts that come on the business channels and how they feel about the price of oil or gold or what have you. The knee-jerk reaction to this market's going much higher, I need to buy in, or I need to get out of my short position, which is of course quite common. Open interest was falling in gold and silver when it was making all-time highs. That means that weak hands were buying the market. It wasn't strong hands in for the long haul. And now we just saw the same thing in crude oil. Investors who were short the position are buying their way out of their short contracts in order to cut off any type of risk that they have. The idea that oil just went from $75 a barrel to 120 basically overnight means a lot of panic buying was going on. And in the industry, there's something called the GMO, and that's get me out. And that is like the type of buying that took place in precious metals a month or two ago. And now what happened, I think, in crude oil this past week.
What mindset helps traders avoid those emotional decisions? Is there a way to be like, can you check out and be like, you know what? I get this is happening, but I'm just going to stand pat. Like, is there a certain mindset that can help traders avoid that whiplash that they'll get if they're consuming CNBC and Fox Business all day long?
No, you can't avoid it. It's very difficult to have a position going higher and higher and higher, and one expert after the next coming on TV. Obviously, they're on CNBC. They must know what they're talking about. They're on Bloomberg or Fox Business. They got to be experts at this. And they start saying 150. a barrel and they start saying $200 a barrel, it's going to get your heart racing a little bit, especially if you're short a position. But do your research. There's 1.4 billion barrels of reserve in China. There's 400 million barrels floating on the ocean right now. And the fact that perhaps the Strait of Hormuz is closed temporarily for 10 or 20 days, that doesn't change dramatically, the fundamental facts that oil is plentiful. What's now going to happen, Joe, of course, is this spike is going to reduce, consumption over the next 2 to 4 to 6 weeks. So while we have to make up some barrels and get them back on the market, we are going to have less demand. So I think we see that kind of balancing off as we go into the spring of the year.
Yeah, I mean, I went to put half a tank of gas into my Subaru, which is a very small vehicle, and it cost nearly $40 for half a tank of gas. So I think people are scared. They do not want this to continue. But then again, like we talked about, even if the conflict does end, we are not going to see those gas prices go down that fast. And so these emotions will continue to ride. And I know, James, you are a historian in the scape of commodities. And I'm curious, is there anything that you can, like, do you see similarities with the energy spike during the 2000 commodities boom? Like, are there any similarities to what's going on with energy now and what happened in the commodities boom in the 2000s?
You know, it's a lot of investors getting into commodities perhaps for the first or second time ever. We always talk about the perfect portfolio alliance, and that's 60% stocks and 40% interest-bearing accounts. And I think it's going to be 60, 30, 10. People have really been introduced to the world of commodities recently. Hopefully, a lot of people made a lot of money in this rally in gold and perhaps in this rally in oil that just took place. So we really see investors coming into this market in droves. It seems as though earlier in the 2000s, commodities were just this very wacky, weird, difficult to wrap your arms around, fundamentally and as an investment. And so many people this year traded in their Bitcoin for gold and silver coins, and I think they made a fortune. And I think these new investors are probably here to stay.
So which boom was bigger, the 2000s or this one?
This one, yeah, on a percentage basis, and especially in a increment of time, this rally just really wrote the history books, and I think we're going to be looking back on these chart patterns that, which is what we follow constantly. We read and study and analyze fundamental factors, but we do look at charts quite a bit, and the chart looks very top heavy, and it looks like a missile itself. It went straight up, and now it looks like it got shot down. We'll see.
All right, James. So let's look at the future. What structural forces shape oil demand over the next decade? Is it going to be that we're going to see this movie again and again every time there's a conflict? Is there anything else structurally that will keep these prices in check and not see such a wild swing that we've been seeing over the last couple of weeks?
Joe, that is the question that everyone is talking about right now. And the answer to that is this. If the Strait of Hormuz gets secured, if the Iranian situation is quelled, and if there's no longer all this idea of, well, Iranian barrels are going to come off the market. Iran used to produce 4 million barrels, which made them like the fourth or fifth largest producer in the world. If they go back to doing that, because right now they're exporting like less than 2, and it's like going on the black market. If they're producing again 4 to 4.5 million barrels a day, Venezuela, who used to produce almost 4 million barrels a day, they're producing less than 1 with what's happened there over the last several years. You get Iran pumping out 4 to 4.5 million barrels, Venezuela pumping out 3.5 million barrels. And if the Strait of Hormuz in that area gets put in a really good place, you're going to see oil stabilize at slightly lower levels than what we're used to this past year. We were trading in the low 60s, upper 60s, which everybody's happy with. Producers like middle 60s, consumers like middle 60s. And if we get Venezuela back online, and if the situation in Iran takes care of itself, hopefully over the next 2 to 4 to 6 weeks, And I'm not even thinking or talking about the Iranian people. They're like, wouldn't it be nice if they had an amazing life? Um, Hopefully all those things happen. And hopefully that's what we're doing there to try and, justify exactly that. Oil could be sitting between 55 and 65 yearly. And that's what we see happening if the Iranian conflict turns into something positive as far as a positive result. You've got the Venezuelan situation. That's going to turn positive, I believe. And you're going to have some really stable oil prices, I think, starting later this year and perhaps 2027, 2028. Really stable price, and I think people are going to like that.
Excellent. I want to ask a couple of questions about other metals because we talk about silver and gold a bunch. I know obviously oil's been a big topic the last few weeks, but like, how about like copper or lithium? Do they send signals about the broader economy, or because they seem to be forgotten many a time, but we all know how important those are. Do other those like I don't want to say forgotten metals say anything about the broader economy? But what's your take on those?
Well, the move in gold and silver this past year made a lot of people forget about a lot of the metals, just simply because of how dramatic in percentage basis it was. Copper's called, Dr. Copper, which means, it talks about the health of the economy. And when the copper production is low and it's being outstripped by demand, it causes a lot of people to take notice. Of course, the AI build out is silver and is copper. And, copper ran into a little bit of the same thing that silver did. Everyone thought these centers were going to be built overnight, and it's simply going to take years. So copper, which of course is a great gauge of economic growth, both here and as well, of course, in China. When that takes a bit of a backseat, it tells people that the economy is not, running as hot as they thought. And while copper is not a highly traded commodity at our office, it is a great barometer of global economic strength or lack thereof. We follow it very closely, and I think a lot of the people that are in the industry are doing the same.
Interesting. So that's funny. So there is an impact of copper, but it doesn't make the headlines. As that's funny how important it is. Yet people don't talk about it so often. And is it just because of the price point? Is that probably the main driver?
It's much less actively traded than gold and silver. If you're trading in your Bitcoins, you're not buying copper with it. You're buying something a little more exciting like gold and silver, perhaps. But the price of silver and the price of gold certainly are a good barometer of speculation, and the value of copper is more of economic strength or lack thereof, like I mentioned. When copper makes a new high and precious metals are just doing what they're supposed to do, which is just kind of go sideways, I could see copper perhaps being in the limelight later this year if there are lower U.S. interest rates to a certain extent, if the Chinese economy shrugs off these high energy prices, which I think they'll be able to because they're sitting on so much oil. I could see copper getting back in the news in the third or fourth quarter of this year when gold and silver maybe are taking a back seat to the brown metal instead of the yellow and white one taking the headlines like it is now.
All right, James, that's going to wrap up another episode of the Courtier Commodity Report. If folks want to connect, find out more about you, they can go to CourtierCommodityReport.com. James, thanks again. I will see you next time.
My pleasure, Joe. Always a pleasure.